welcome to another lesson from Lesson Up Squad. Today we'll be learning all about notes to financial statement. This will be the first lesson of this whole series. In this lesson, you will be learning what is a note, why it's important to have a note, the different type of statements that are in a financial statement pack, the explanation of the fixed asset notes, format of all the other notes, and adjustments on books versus adjustments on balance sheet. So let us start from the very basic. What is a note? Each financial statement pack comprises of many different types of statements. And if you've never seen a full statement pack, I suggest you Google, say for example, any listed company. You can Google Sasol, you can Google Woolworths, and see all the different types of statements that are available in one financial statement pack. Each statement that's in the pack has its own purpose and tells its own story. The income statement, for example, will tell you the profit the company has made during the year. The balance sheet will tell you the financial position of the company. For example, all the assets, liabilities, and equities. The cash flow statement will tell you the cash position of the company. And the note is additional support to show you how a number is made up on your statement to tell the users about any different transaction or business. So notes just basically give you more information about the numbers you already see on the financial statement. All of this together will give you the full picture of what is happening inside a company, and this is very important for people who actually use these financial statements. So let's get down to the basics. What is a note? It's very important to understand what a note is, and you'll understand this why later in the video. Notes are a breakdown of the value on your financial statement, so they actually show you what that value on your balance sheet or income statement is made of. As an example, I have a balance sheet on my left hand side. You'll see that the example I have chosen is the PPE example. On my right hand side, I have the PPE note. Both of them, the value is the same as I've highlighted in yellow. The right hand side tells you what the value is made of. So basically what the 9.58 million is made of. Whereas the left hand side will give you the summary on your balance sheet. So a note is a requirement in the Companies Act. Because it's a requirement, you can already see that this is probably a very important element to be included as part of the financial statement pack. Different users of the financial statement require different information for different purposes. What is important to one user of the financial statement is not necessarily as equally important to another user of the financial statement. Each user wants certain information out of the financial statement for their own purposes. For example, the owners of the business would want to see if the business is doing well. Is it profitable? Banks and financing institutions, they want to use the financial statement to see whether they can grant further loans to the business. Will the business be able to repay? Similarly, creditors want to know whether the business is credit worthy. SARS would like to know it for income tax purposes. And then you have potential buyers. They want to know if this business is a good investment to buy the business. Therefore, you can see that not everybody uses the financial statement in the same way. Different people have different interests, and therefore they want different information. And the notes will help you get that additional information. Let us now go through a format of an income statement. This is a generic income statement format. The income statement will have all your income and all your expenses. The income statement will also have a column for notes. In this column, you will have references to these numbers. These will tell you, for example, note number 1 will be interest income, note number 2 will be interest expense. Another reason why interest income and interest expense or any other element on your income statement is shown separately is because it is not part of your normal business activities. That's another reason why sometimes numbers are supported with a note, because it's not part of your normal business activity to earn interest income and interest expense, and those are your common ones which you will always have a note for. The steps to building your income statement is very simple. Step number 1 is to always write down your format. Writing down the format gives you a guidance as to what you need to put down next. Number 2, on your question, mark all your income as I and all your expenses as E. You can choose to highlight them in different colors, but make sure you make a differentiation between them so that you're able to see, especially when you're under pressure during the exam. You don't want to make a silly mistake. So make sure that you highlight it well enough or indicate it with the I and E so that you do not confuse yourself in the exam. Number 3, write down all your income under other operating income except for sales. Just like that, write down all your expenses under other operating expenses except for cost of sales. Always remember to show your adjustments in your bracket. Remember, the end amount in your note must always equal to the amount in your financial statement. So if in your interest income, say for example, you've got 1,000 Rand on your income statement, that means in your notes, you should also have 1,000. So let us look at an example of how to do an income statement. But before we get there, I'd like to focus on a few things. Here we have a pre-adjusted trial balance. The word pre-adjusted means that it's a trial balance that still requires adjustments to be made so that it can be a final trial balance. Also want you to take notice of the sales and cost of sales. Remember, like we said, sales and cost of sales do not go under other operating income and other operating expenses. They are the primary line items in your income statement, and they'll be the first 2 line items on your income statement. Also take note of the fact, interest on current account. Sometimes you have a line like this. It says interest on current account. You don't know if this is an income or an expense, and you would only know that because this goes into the debit column. You can see because it goes in the debit column, it is an expense. So this will be interest expense. I'd also like you to take notice of rent income. I highlighted rent income so that I may not forget that this goes under other operating income. The rest I know by default will then be other operating expenses. I've also got some adjustments here that are required to be made to this pre-adjustment trial balance. And what I like to do is I like to read the adjustments, and I like to see the accounts that are affected for each adjustment so that I know which line items I should actually be adjusting in my income statement. So for example, let us look at number 1. It says part of the building has been let to TT Traders at 720 per month. Rent for February has not yet been received. Remember now, this is an accrual income. It's money you were expected to be received for this year, but you have not yet received, and your rent account. So these will be the 2 accounts that are affected. If you are unsure about how accruals work, I'll link the video to the accruals just above here, and you should be able to click on that and watch our video on accrual so that you know how to deal with accruals better. Back to number 2. The balance of the account of S. Smith, a debtor, must be written off as irrecoverable. He owed to the business 480 Rand. Adjustments for bad debt plus debtor's control. Number 3. Advertising paid for the period. You can see in this case you've paid advertising for a period that is after your year end. That means it is prepaid expenses and it is advertising. Number 4. Depreciation on vehicle is calculated on cost and on equipment add on the diminishing balance method. So this will affect your depreciation and accumulated depreciation. Adjustment number 5. An amount of 250 has been paid for repairs to the store. The amount is posted to the land and building account. So this is number 5 is fixing an incorrect entry, which is your repairs and your land and building. So I like to identify the accounts that are affected so that I know when I am working with these accounts on my income statement, this can't be my final value that I put. So for example, where there are no adjustments that we've noticed. So say for example, wages. There was no adjustment to wages. That means you can put this amount directly in your income statement. But for example, rent, you would put this amount 15,840 plus your adjustment. Okay, let us now show you what the impact of all those adjustments and the amount you had on the trial balance will have on your income statement. So here you can see you had this generic format of your income statement, right? So you had to put down your income statement format, And like I said, you would bring down all the balances into your income statement for amounts you do not need to adjust. I don't want you to focus so much on the amount right now, but rather on the principle as to how to do the income statement, right? So you would see here your adjustments that we spoke about on the previous slide. So we couldn't bring down advertising the 5,460 in your income statement directly because there was an adjustment required. Remember, it's very important to show these adjustments for school purposes. If you do not show the adjustment, you are going to lose marks. So make sure that you show the adjustment in the brackets. So you would bring down the balance from your trial balance, and then you would adjust your advertising or whatever line item that is affected, and then put your final figure in the last amount total column. Also want you to take notice, interest expense by default, like we said, interest expense is something that is not part of normal business activity. And by what I mean by that is you don't open a business to earn interest income or interest expense, right? So this is something you get almost extra for as part of your business. So it's not something that's normal as part of your business, and therefore we have to have a supporting note for this. Right? And your note would look something like this. Note 2, interest expense, interest on loan, 70 Rand. In the real world, you'd have more information to this loan. So for example, if you actually open a real financial statement, you will see that it will say the loan was taken from XYZ Bank, it was taken at this rate, we make monthly or quarterly payments, the interest is capitalized, not capitalized. So there will be more details in the note. For school purposes, this may not be required for you now. Let us now look at the steps to build a balance sheet. Number 1, write down your format. I cannot emphasize how important it is to write down your format. The format will guide you during the exams when you're under pressure as to what to do. So always remember, when you see your question says do an income statement, a cash flow statement, or balance sheet, firstly go put down your format. That is your guide in the exam as to what you need to do next. Step number 2 is on the question paper, mark all your assets, liabilities, and equities with A, L, and E. You can once again use a highlighter if you wish to, but make sure you have a clear distinction between these 3 elements so you don't confuse yourself. Step number 3, you write down all your A's under your assets, but with balance sheet you need to be careful. You need to split between current and non-current assets. Current assets are those assets that are current, which are able to turn over in the next 12 months, such as your inventory, such as your cash. Non-current assets are assets that are there for the long term. So for example, your fixed deposits, your property, plant and equipment. Same thing for liability. Write all your L's under your liability. Don't forget to split it once again between current and non-current liability. We'll speak about this later in the lesson. Then lastly, write down all your E under equity. Remember once again to show all your adjustment in brackets. If you don't show your adjustment in the brackets, you're going to lose marks. So here's a generic example of a balance sheet format. I just want to show you quickly. Here you have your your non-current assets, which you can see are your fixed deposits longer than 12 months, your fixed assets, or your current assets, which are your inventory, trade receivable, cash and cash equivalent. And you've got your equities and liabilities here, and then you've got your non-current loan. So just to remind you that the balance sheet is a reflection of your accounting equation. The top part, which is your asset, must equal to your equities and your liabilities. That is why the equities and liabilities section is together at the bottom. That's because your assets must equal to your equities and your liabilities. Just a quick reminder, in your notes, the amount in your notes must equal to the amount that you have in your financial statement. That could be your income statement, your balance sheet, or your cash flow. But the amount that you have in your note must equal to your amount in your financial statement. I want to now explain a very important note of the balance sheet, which is your fixed asset note. It's usually known as note 3, and it's usually known as note 3 because note 1 is your interest income, note 2 is your interest expense, and then note 3 will be your fixed asset note. The number of the note doesn't really matter, so you don't need to worry and ponder about that a lot. The fixed asset note is the note that tells you all the movements about your fixed assets. Now, your fixed assets are your land and buildings, your vehicles, your furniture, your computer equipment. It could be many things, right? But these are what your fixed assets are, and your fixed asset note tells you the movement on those. So, for example, you have your land and buildings. In this example, you've got your land and buildings and your vehicles, right? And you would see you've got the movements, right? So the top part is your balances at the beginning of the year. These are balances you bring down from your trial balance and are given to you at school level. Then you've got your movements. Your movements can be your additions that you've bought during the year, disposals, which will be the fixed assets that you have disposed during the year. Depreciation will be the depreciation for the year. So these are your common movements at school level that will happen on your fixed asset note. And then your last section of your note will be a recalculation of the balance at the beginning of the year and the movement, and that gives you your balance at the end of the year. So number one, I would always suggest that you write down the format when you're doing your fixed asset note. Remember, the format does not change. The format is divided into three: your opening balance, your movement, and your closing balance, right? You know your opening balance is usually given to you. Your movements can only be additions, disposals, and depreciation, and your closing balance is a recalculation. So this can be a very easy note where you can earn lots of marks if you can just put down your format and follow it through. Okay. So I want to now explain the other notes that are part of your balance sheet. So the other notes that we can look at is inventories and trade and other receivable. So once again, here are notes giving you more information. Look at this. Inventory tells you there is trading stock and consumable stock on hand. Trade and other receivable tells you that you have trade debtors and other receivables. So in its name, you can already see that you're supposed to have other receivable. So any amount that you're expecting to receive, which is basically your accrual income, any deposits, and even prepaid expenses. Because remember, prepaid expense is something you've paid. You're still expecting to receive its services because it's been prepaid. Therefore, it will go under trade and other receivable debt. Here you have other notes of the balance sheet. One, which is cash and cash equivalent. Here you can see once again, cash and cash equivalent is giving you more information about the type of cash you have. So always keep that purpose at the back of your mind, that a note is giving additional and more detailed information about what's on my financial statement line item. Right, so you've got your cash equivalent. It tells you you've got bank, cash flow, petty cash, and fixed deposits maturing within 12 months. You've got also in the capital, you've got your balance at the beginning of the year, your profit or loss for the year. This profit or loss for the year comes from your income statement. Then you've got your any additional capital that you've contributed. This will be told to you as an adjustment. Drawings, any money you've taken out of the business, this will also be told to you as an adjustment. And then you've got the balance at the end of the year, which is what you recalculate. Remember, this value should equal to the value on your financial statement. Very similar to trade and other receivables, you've got trade and other payables. In this, trade and other payables is telling you all about the amounts that you need to pay, but not only trade creditors, not only your trade payables, also all the other payments you have to make. So that would be examples would be accrued expenses, income received in advance. Income received in advance is a trade and other payable because you still need to render the service, right? Then you've got your SARS, your medical aid, your pension fund. All of these are items that you still need to pay. They are a liability and therefore they are on your balance sheet, and if they are on your balance sheet, you should be supporting them with a note. Okay. Let us now quickly talk about the adjustments that happen in the book versus adjustments on financial statement, what that means and how it affects you. So adjustments in the book are adjustments that happen in your ledgers through a journal, versus adjustments in your financial statement are adjustments that do not need a journal. These are just adjustments to split amount. This is very common for splitting loans to current and non-current, for splitting your fixed deposits between current and non-current assets as well. And for example, when you're adjusting something in books, it affects two accounts, where when you're adjusting something on your financial statement, it's affecting only one account. It impacts the same account. It has no extra adjustments to it. You're just splitting the amount. I think it will become clearer when we look at an example. Okay, so here's an adjustment that we make on a financial statement and not in the books. So once again, you do not do a journal entry for this. You do not debit or credit anything for this. You would just do it on the face of the financial statements, and that's what it means when you are adjusting something on the financial statement and not in the books. Here you've got a loan. You've got a loan for 100,000 and they're telling you 20,000 will be paid within 12 months. Therefore, you know the balance, the 80,000, will be paid later on after 12 months. You can see here on your balance sheet, 80,000 is under long term. Short-term portion of loan is years 20,000. You did not do a journal for it. You didn't debit or credit any accounts. You just simply split the loan amount into current and non-current. And that is what is known as adjustment that is made on the financial statements and not inside the books. Here's another example of splitting a amount. Here you got a fixed deposit of 100,000, of which 20,000 will mature within 12 months. That means 20,000 Rand will be your short term. Short term will go under your current assets and as part of your cash and cash equivalents. Therefore, you have your 20,000 as part of your cash and cash equivalents. The 80,000 will go part of your non-current assets as financial assets as a fixed deposit of 80,000 Rand. Very important to see, you did not debit or credit any account. You did not do a journal. All you did was you took the amount and you split it into different places on your balance sheet so that the users of the financial statement can understand what is going to happen in the next 12 months and what's going to happen after the 12 months. Therefore, there was no journals, and therefore this is an example of adjustments that made on the financial statement and not in the books. So things that we learned today that were very, very important is different formats of all the notes. You've got why we need notes and what are adjustments made on books versus made on the financial statement. If you've liked the video, please give it a thumbs up and share this with your family and friends. That's all for today, guys. Thank you so much for watching. Hope you guys have learned. If you still have any questions, please feel free to drop me a mail, subscribe to our YouTube channel, follow us on Instagram, feel free to ask questions in the WhatsApp group, and most importantly, please share this initiative with all your family and friends so that everybody can benefit. Thank you once again so much for listening. Until next time, bye-bye.